Good morning, guys. Here in Amrin Fatima, Assistant Professor, Department of Commerce, SRM Institute of Science and Technology, and I'm going to explain you the concepts of income tax law in practice one. Whereas, like taxes which is levied by a government on a product or income or any other activity carried over by the citizens of the country. Whereas the purpose of getting the taxation by the government is to finance the government expenditures, which could be like classified into two forms as taxes. The first form is direct tax and indirect taxes, whereas direct taxes which consist of income tax, wealth tax, corporate taxes and gift taxes, whereas indirect taxes which are like classified into like excise duty, custom duty and sales duty. Thus, why is the tax required to the government? It is the part of individuals' earning which is required to be paid by paid to the government in order to generate the revenue or a mandatorily liability for every citizens of the country, which is like two types in two types, which is direct tax and indirect tax, whereas income tax comes under the direct taxes. Why is tax mostly required to the government is to like initiate various welfare activities such as building hospitals or to develop the infrastructure or for the national security or salary pension after the retirement to the government employees, whereas such kind of subsidies to cooking gases, fertilizers and other essential commodities. Whereas the canons of taxation is written by Adam Smith. Whereas canon is a good tax system. A good tax system is very easy to administrate, and the burden of the taxation will be justly given to the employees or the citizens. Whereas canon of equity, a good tax system should be equitable, which is tax equitable to all persons, whereas the person should be taxed according to his or her ability. The principle recommends the progressive tax system, which is equity, which has to be equitable to each one, to the citizens. Next one is canon of certainty, whereas the canon of certainty is nothing but the time of payment or the mode of payment should be like certain or clear to the taxpayers or and the tax officials. Whereas canon of convenience, what is convenience? The tax system should be convenient in terms of time of payment or mode of payment to the taxpayers, whereas canon of economy is that the canon recommended collecting taxes should be as minimum as possible, which must be as minimum as possible, whereas canon of elasticity, whereas the demands of the government increases or decreases by any chance, which is tend to be a canon of elasticity. Whereas canon of productivity, what is canon of productivity is nothing but which is said to be a canon of adequacy. Adequacy is the tax system which should be enabled to collect it sufficiently for the revenue purpose, whereas canon of simplicity, which must be very simple to the taxpayer. The taxpayer must have the awareness on how he pays his taxes, whereas canon of diversity. What is canon of diversity? The country's taxes structures should be like dynamic and diverse in nature rather than having a single or double tax system. Whereas canon of uniformity. What is uniformity? Which refers to the uniformity imposing the taxes or assessment of taxes, realization of taxes. And next, the last but not least, which is canon of coordination. Canon of coordination, which states that the tax authorities should be well coordinated to receive the taxes from the citizens of the country. Like income tax act, which is like established by 1961 only for the purpose of like receiving the receiving a part of a salary of a person for like paying the individuals to form the revenue of the government, whereas which comes under the incomes. Income plays a major role in the country. whereas which contributes on the voluntary contribution, profit in lieu of salary, or city compensatory allowances (CCA), or any kind of the earners allowances by the company, or benefit or prerequisites to the directors, any benefit or prerequisites to the representative assessees, or any kind of insurance profits, or banking income of the cooperative society, employee contribution towards the provident fund PF, or any other amount received under Cayman insurance policy. Whereas these kind of incomes are used on income taxes. Thus, heads of income, which is like classified into five forms. The first form is income from salary, and income from salary is the a part of salary from a citizen. Next one is income from house property. House property, out of your house property, what kind of house property you like let out your house property, or you give for the shopping purposes, or any other. Though out of your house property you pay your income taxes. Whereas income from business or profession, whatever you receive the output out of your business or profession, that will be paid under this head. And the next one is income from capital gains. Capital gains is nothing but the gains which you receive apart from your business, extra incomes, which is said to be a capital gains. The last one is income from other source, which whereas its examples are like incomes not from your salary, nor from your house property, or not from your business or profession, or not from your capital gains, apart from that which you earn out of the betting or lottery. These kind of incomes comes under income from other sources. So thus, what kind of important terms which we learn in income taxes are: an assessee, the one who pays the income tax, or the one who is eligible to pay the income tax, are the simple terms, the one used for the taxpayers. Whereas we'd like to learn the terms as assessment year and the previous year. Whereas the assessment and the previous year is, our previous year is 2019 to 20, whereas our assessment year, which will be our current year, as 2020 and 21. We are going to look at the residential status of an assessee according to the Income Tax Act 1961. So, who is a resident? A resident is a citizen of India who reside in India for a period of 182 days or more in during previous year. His income earned anywhere in the world will be taxable in India, whereas NRIs, non-residents of India, those income earned in India will be subjected to pay in India, whereas residing but not residing in India, residing as being at home but not residing in India, as he have went for abroad for his work purpose. Thus, that kind of citizen of India who stayed in India for less than 182 days, but during previous years, his or her income rising out of India may also be taxable in India. Next one is like incomes, gross total income, which is comprises on sum of income earned under the five heads, like income from salary, income from business, income from house property, and income from capital gain, under those kind of five heads of income without any deductions. So what are deductions? Let us look at the deductions. The amount which is allowed to be deducted from our gross total income before determining the tax liability of an assessee, such as certain savings, donations, etc. And the next one is total income. So thus the gross total income, which is deducted from the deductions which we receive out of the donations and certain savings, and this is the net taxable income of assessee. Whereas the next comes, and which plays a major role in income tax, is exemptions and deductions. Whereas the income taxpayers, the assessees, the taxpayers could claim for their exemptions and deductions through under these five heads. So first one is exemptions. A part of income which is like not taxable, it is required to be deducted before computing gross total income. Example, at rupees 26,000 per month, and like so many, in case of exemptions cannot be like more than gross total income. Thus the deductions are the amount of expenditure like incurred by individual towards specific and deducted from gross total income. Before computing those tax liabilities on listing, the deductions are appended appended with such uh, basic things, whereas the residential status of the individuals have been looked after under basic conditions that those individuals must have stayed for 182 days for the period of 60 days or more for the previous year, or 365 days or more in any years. And we have certain additional conditions: being stayed in India as residents of India for at least 2 out of 10 years under the previous year, could be taken over to the residential status of India, or he couldn't pay the fees, or he couldn't pay the taxation. Thus, when he stays in India for a period of 730 days or more in 7 years, 7 preceding years, thus these kind of additional conditions and the basic conditions could be taken over to the residential status and the tax liability according to section 6. And thank you for watching this video, and thank you for your patience. Thank you. Thank you listening. Stay safe and stay happy. Thank you.